Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 28th of January 2019 and we're looking at European Central Bank President Mario Draghi's comments made today against the backdrop of minimal growth of the three largest EU economies, Germany, France and Italy, and even poorer future projections. Now, this follows the bank's repeated warnings of slower growth in the future. Last week, the ECB, European Central Bank, left its interest rate and economic policy on hold, but issued a warning that lower growth prospects could worsen and last longer than originally feared, and that although they had cut back on its QE program, it may have to reverse and enlarge it to support this downturn. Draghi told the European Parliament's Committee on Economic Affairs in Brussels, quote, "The Eurozone economy has performed worse than expected in recent months, and global uncertainty is weighing on economic sentiment. Over the past few months, incoming information has continued to be weaker than expected on account of softer external demand and some country and sector-specific factors. The persistence of uncertainties, in particular relating to geopolitical factors and the threat of protectionism, is weighing on economic sentiment. Significant monetary policy stimulus remains essential to support the further build-up of domestic price pressures and headline inflation developments over the medium term. The Governing Council stands ready to adjust all of its instruments as appropriate." Unquote. The ECB has essentially two obvious options. One, it could offer banks another round of cheap long-term loans to make sure they continue to lend to the real economy. Or two, it could put off any envisaged first rate hike later into the year. But this would tie the hands of a new president, who is likely to be named after the European elections in May. So, we have a prospect of the Bank of England being cautious because of Brexit, the ECB likely to revert back to some form of QE program, and the Fed offering a dovish tone for 2019, thereby keeping interest rate rises in check and possibly reversing its quantitative tightening program. With China and much of the world forecasting lower GDP growth for this year, it does not bode well for consumer sentiment, which invariably will cause consumers to reduce spending out of fear, and thereby potentially exacerbate the problem and making it worse. So the obvious question then, of course, is what will happen to gold and silver prices against this backdrop? Well, that is the $64,000 question. If you look over recent history from the 70s until today, we've had gold and silver rise and fall when rates have risen, and rise and fall when rates have fallen. So if we were to assume that we will have lower growth globally, this will indeed affect the demand for silver by industry, which represents close to 60% of demand. This will have a negative impact on silver prices. Conversely, lower growth rates are likely to lead to fiscal stimulus and lower interest rates, which invariably improves the opportunity cost situation for holding gold. In other words, the lower the interest rate, the less you are losing by holding gold compared to, say, bonds or government securities or gilts, as we call them in the United Kingdom. So this should be good for gold prices and therefore for silver ones too, which will benefit by association. How that balance pans out, of course, depends on severity of global demand demise and levels of stimulus introduced. Either way, we're beginning to witness a scenario whereby all of the major currencies may find themselves under pressure. The US dollar, the British pound, the European euro and the Chinese yuan or renminbi. By definition, this could reduce the demand for gold because pro rata it becomes more expensive in those currencies. But much depends on their interrelationship, of course. So we could indeed find ourselves in a situation whereby the gold price initially rises and then falls back again, similar to 2009 to 2011, and then from 2011 to today. Now, we're not predicting this as yet, as we haven't undertaken all of the necessary calculations. And when we do, we shall publish them within the Inner Sanctum first. However, to all of our subscribers, we alert you at least to look at these measures and what the main central banks are doing. Because whether you love them or hate them, they certainly have an impact on all of our lives. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.